This is Horizons Middle East and Africa, our top stories this morning. Asian stocks gain following a global rally as traders look past the political impasse in Washington. The White House plans to dismiss federal workers, saying layoffs would happen imminently. President Trump says he'll press China to restart soybean purchases when he meets Xi Jinping later this month. And Bloomberg has learned Hamas is being pressed by Arab and Muslim leaders to accept Trump's Gaza plan. We are live in Jerusalem with the latest. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa. I'm Jennifer Zapasaja in for Jumana Bersechi, and it is officially the second day of the shutdown. We're going into the second day. But if you take a look at where equities are right now, some people would say shutdown. What shutdown? Especially if you take a look at U.S. equities. Investors seemingly shrugging off the fact that we still are at an impasse as far as the U.S. government goes. U.S. equity futures marginally up right now. S&P futures tilting higher. And we actually did see the S&P again notching another record, even in the face of the first shutdown in 7 years. S&P futures, as I mentioned, up right now. The U.S. 10-year yield, we are seeing yields marginally up right now, but we did see treasury yields actually pulling back after we did get a surprise private data print on Wednesday that showed payrolls actually falling last month, and that helping to reinforce bets that potentially we will see Federal Reserve cuts later this month when the MPC does meet again. But the U.S. 10-year yield right now at 4.1039 there. I do have the MSCI Emerging Market Currency Index on the board as well. It's largely flat, but the reason why I think it's notable is that we did see 3 straight days of gains for the index, that coming as we did see the dollar slipping. But right now we're seeing the index for the MSCI EM Currency Index a little bit flat. Gold also on the board. I didn't get a chance to mention, but we did see the South African rand actually being one of the beneficiaries of a weaker dollar, actually hitting the strongest level in over a year against the greenback. The rand is also one of the beneficiaries of increasing gold prices. Gold right now largely flat, a bit steady amid the shutdown, but still we have seen the metal rallying for 5 days straight. Right now, spot gold at $3,865 an ounce there. And really quickly, let's bring you our terminal chart of the day, and it's indicating signs of potentially waning oil demand that's continuing to rise. We got some data overnight that showed U.S. crude inventories continue to climb. That is coming even in the face of Trump's pressure for a Gaza peace deal. And also, we are waiting for that OPEC Plus meeting coming this weekend, leading many analysts to suggest potentially we're seeing oil at risk of breaking a pivotal level. Right now, Brent crude is up on the day, but trading at about $65.73 a barrel there. But that is just a look at our terminal chart. Let's check in, though, on how markets in Asia are faring. Min Min Lo is standing by in our Hong Kong studio for more. Min Min, quite a bit of green on the screen there.
Yes, U.S. shutdown or not, tech is really the only story in town in Asia. We're talking about OpenAI signing a deal with Korean chip makers like SK Hynix and Samsung, a new data center in South Korea. That is lighting a fire under the Kospi, up by 3% today. And we're seeing an intraday record high on the Kospi. TAIEX is up as well because Sam Altman's tour in Asia also included a meeting with PSMC. And that's why we're seeing the TAIEX up by 1.6%. Hang Seng as well, a catch-up rally there after reopening after the National Day holiday yesterday. Mainland markets are still shut, but flip the board, take a look at the chip sector, Korean chips in particular. I'm talking about SK Hynix looking at 10% gain here, and it's lifting all boats, right? Look at Tokyo Electron, also up by 7%, even though it's not been a part of that OpenAI deal. And there's really this AI euphoria taking hold across Asia because you look at China as well. Flip the board. Alibaba also in focus because JP Morgan had raised the price target for this stock by 45%. That's massive. We're talking about price targets of 240. And, JP Morgan is saying that the narrative around around Alibaba is shifting away from being that market loser in the e-commerce space to being the top tier player in Chinese tech. Baidu following actually leading gains here, up 4.5%, and some of the chips plays as well. SMIC up by a whopping 9.3%. Jen.
Wow. Min Min Lo in Hong Kong for us. Min Min, thanks so much. We'll check back in with you in quite a bit. Let's get you the latest, though, on the U.S. government shutdown, with the Trump administration saying layoffs will start to happen soon.
There are unfortunate consequences to a government shutdown, and the federal government is not receiving any cash at the moment. And so the Office of Management and Budget has been tasked with looking over the receipts and looking over the budget of the entire federal bureaucracy. And as the vice president said, determining what needs to continue to go out the door and what can we continue to keep running and what unfortunately is going to have to come to an end. So those decisions are being made. And unfortunately, layoffs are very likely, as the vice president just said, going to be a part of that.
For more, let's bring in news desk editor Jill Desis to dig into this. Jill, so we just heard from Caroline Levitt there about potentially what could come. Give us the state of play, though, where we are at as far as Democrats and Republicans and what they're asking for right now.
Sure, Jen. So I think that at this point, we're still kind of where we were right before the shutdown really began, which is that the Republicans are trying to get this, stopgap bill over the line. They'd like to at least continue funding the government in the short term. And the Democrats have made some policy demands, mostly surrounded around health care, that they say are really these non-negotiables here. So the big rub is the Democrats would like to extend some Obamacare subsidies for Obamacare premiums. The big question there would just be if these subsidies are not extended, then a bunch of people's premiums are going to go up within a few weeks. And so that's one thing that the Democrats are really holding here. They would also like some additional concessions from the Republicans, including a rollback on some cuts to Medicaid spending that the Trump administration passed earlier this year as part of some tax cuts. But that's ultimately something that might actually be maybe not as sort of a pressing priority as just really getting those subsidies extended. So that's where the Democrats are. The Republicans, of course, saying that they can negotiate that later. We just need to get the stopgap bill over the line first, and then we can return to that. I think from the Democratic perspective, the question is really, do you trust Republicans that are ultimately saying that? So that's where we stand, and I think that's sort of what we're waiting on to ultimately be resolved.
Is there any indication, Joe, how long this impasse could go on for?
I mean, at this point, Jen, I think, it could be anywhere from a matter of days to longer. The real question is whether you actually get a pathway out of where things stand right now. And I think there's probably a couple of different ways that you can ultimately see that. It could be that the Republicans are able to successfully get the 8 Democrats that they need to join them to keep the government open, or reopen the government, rather. That's one thing that you could see ultimately happen here. Would point out that they already have, I think, 3 Democrats that did vote to pass the stopgap spending bill before, so possibly they only need 5 more. I think that question kind of comes down to whether some of these threats that some Republicans are making over cutting spending, particularly on programs that are really big in blue states that voted for Kamala Harris in the last presidential election, that could be a pressure point, along with some other concerns, particularly those shared by moderate Democrats. So that's one way that you could see this end. The other one is if some of these Democrats really are successful in negotiating for maybe sort of that subsidy premium issue, or maybe something sort of smaller scale when it comes to health care. So there are a couple of avenues out of here. It's just a question of whether you actually get enough to get things going here. But obviously we're not at that point yet. So I think we're going to have to see what Washington is able to cobble together once the U.S. wakes up again.
Certainly. Bloomberg's news desk editor Jill Desis starting us off there. Jill, thanks so much. Let's stick on this story, though, and dig into how investors have largely looked past the political impasse in Washington. And joining us now to discuss is Paul Gruenwald, Global Chief Economist at S&P Global Ratings. Paul, thanks so much for being here. We just had Jill walking us through where we're at right now with the impasse. But if you take a look at equities, we're not seeing much volatility at all. How are you assessing where the current state of play is for the shutdown in the U.S.?
Right. First, thanks for having me on the show. We just issued a paper yesterday sharing our views on the shutdowns. Historically, these have been relatively short. The impact on GDP has been relatively modest. And when the shutdown's over, the effects have been largely reversed. Just to put some numbers around that, we think that for every week the government's shut down, it subtracts 10 to 20 basis points from GDP growth. And to give you an example, back in 2013, the government was shut down for 16 days. That subtracted 30 basis points from growth, but that was largely recovered after the shutdown was lifted and people got paid. So we're watching, obviously, the length of the shutdown, what your colleague just discussed, and some of the wild cards about actually laying off people rather than putting them on furlough. But that's all to be seen.
What are you looking out for then, Paul? Is it potentially any sort of indication from the Democrats if they do plan to step back on some of their demands? Is it for layoffs that do happen? What do you think is maybe going to come imminently?
Yeah, well, I mean, the negotiations are going to happen. What we're actually focused on is the data, because we know we're in a pretty delicate spot right now. And one of the consequences of the shutdown is we're not going to be getting the labor market report on Friday. We're not going to be getting CPI data. So that's going to complicate, for example, the work of the Fed going forward as they look at interest rates. I mean, the negotiations are going to happen, between the Republicans and the Democrats. We know they're centered on health care. But my team's pretty focused on, what the short-term economic impact's going to be, what the impact on the Fed's going to be, and then how long this lasts and whether we get any permanent effects.
Where do we start to see some unraveling, Paul, in the global markets right now? U.S. equities still holding near highs. Asian equities, we've also seen them stronger on the day. Where does that start to take shape, though, if we do move through the shutdown even more?
Yeah, well, obviously the markets are watching the data, as are we. We've continued to be surprised by the resilience of the U.S. economy and the global economy. We just put out a new set of global forecasts. We did raise our growth forecast, mostly on base effects, but Q3 in the U.S. is looking pretty strong. It's tracking 3.5% to 4%. The labor market's still kind of hanging in there. We've got some tailwinds from investment on data centers. So the growth picture is not at all bad. So the markets are watching that. We still think we've got some, policy uncertainty overhang. But so far, the effects of the tariffs and everything have been a little bit more moderate than we initially thought.
What about outside of the U.S., though, Paul? Where else do you look potentially for some unwinding or potentially correction from some of the highs that we have seen earlier in the year?
Right. Well, people are watching rates. The financial conditions overall are actually pretty favorable now, right? The 10-year benchmark is U.S. is about 410. Spreads are low. Equity valuations are high, as you said. So as long as the growth story holds up and the labor market stories hold up, which is a global phenomenon, it's not the U.S., we think we're going to be in a pretty good spot. The cracks we're watching for are in the labor market, and then there are geopolitical risks as well. But so far, as I said, we've been pretty moderate in the impact so far, and growth and sentiment's kind of hanging in there.
Where do you see strength potentially, Paul?
Yeah, well, one of the surprises, as I mentioned, has been the data centers. So even, we don't have a final number, but if you kind of strip out the rest of the economy and just look at the contribution to growth from data centers, mainly in the U.S., that looks like it's close to 1%, or 1 percentage point of growth, even though the rest of the investment story's been flat. We know about the AI race and building out these centers. Yeah. So that looks like a headwind. It looks like lower oil prices over the next year or so are going to be, a tailwind. Looks like a tailwind as well for from lower oil prices. And then the headwinds are obviously the geopolitics and the policy uncertainty. But we do have some tailwinds. We'll see if that takes us into a decent 2026.
Can you say for certain whether or not we will be getting into 2026 stronger, or is it still a bit too early? Considering we have the shutdown, considering we have OPEC Plus meeting, there's quite a few events to go, but what can you say for certain?
Well, the U.S., even abstracting from the current U.S. administration, the U.S. economy needed to slow this year. Growth has been 3 or almost 3 in 2023 and 2024. So that's why the Fed had policy rates on the restricted side. The speed limit for the U.S. economy is 2. So we continue to look for trend growth in the U.S. probably an undershoot. We're going to be below 2 for late 2024 into 2025. And then, hopefully the lower rates, et cetera, will kick in and we get a little bit of a pickup of growth.
Yeah, we'll wait to see whether or not that plays out. Paul Gruenwald, Chief Economist at S&P Global Ratings. Thanks so much, Paul, for joining us and for your insights there. Now, for a look at some of the other stories we are following this morning. The U.S. Supreme Court has refused to allow President Trump to immediately fire Fed Governor Lisa Cook while she sues to keep her job. The decision deals a setback to Trump's efforts to exert more control over the central bank. The order means Cook can remain in her position at least until the justices rule, after hearing arguments in the case scheduled for January. U.S. President Donald Trump says he would press Chinese President Xi Jinping to restart purchases of the crop when the two meet at the end of the month, the soybean crop. China hasn't bought a single soybean cargo from the harvest now underway, instead relying on Argentina and Brazil as retaliation for Trump's tariffs. American farmers are increasingly worried their crops will go unpurchased this year without a trade deal with Beijing. Now, still ahead, activists aboard a flotilla sailing toward Gaza say the Israeli Navy has now intercepted their boats. We're live in Jerusalem next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Activists on board a flotilla sailing toward Gaza say the Israeli Navy has now intercepted 3 of their boats as they approach the besieged Palestinian territory. Israeli authorities say the activists on board, including Greta Thunberg, are safe and being transferred to Israel. Let's go to Jerusalem now and speak with Bloomberg's Dan Williams. Dan, what more do we know about this potential interception at this point?
Well, the interception's been confirmed by Israeli authorities. They've been rather muted about this whole affair. It's not just because Israel is now shut down for a major Jewish holiday. I think it's also clear that the Israelis don't want to add any publicity to what is essentially an attempt by these activists to generate publicity, pro-Palestinian publicity, and challenge this cordon, this maritime cordon or blockade on the Gaza Strip that Israel imposed after Hamas took over that territory in 2007. There have been challenges like this before. This is the biggest of them, something in the order of 44 boats, perhaps slightly larger vessels, hundreds of activists aboard. So it's not quite over yet. It would seem that around half have now been boarded, the activists aboard taken into custody. I expect in the coming hours we'll hear that this is over without incident and potentially without significant impact geopolitically.
Dan, let's talk about the deal that we got from President Trump earlier in the week, presenting to Hamas, and he was alongside, of course, President Netanyahu. He had set a deadline for Hamas to accept this. Have we heard anything at this point, especially as Hamas gets increasing pressure from Arab and Muslim leaders?
Hamas is still seeking counsel. It's still conferring, it says, with other Palestinian factions about this deal. But as you noted, as reported by our colleague Sam Dacher, there is a consensus building, albeit not voluble, not without misgivings, reservations, but a consensus nonetheless among Arab and Muslim stakeholders, with the exception, obviously, of Iran, potentially the Houthis of Yemen, stakeholders looking to see an end to this war, some of them with significant clout over Hamas, and their consensus appears to be that Hamas should accept this deal, perhaps entering its own caveats, its own requests for revisions here and there, but nonetheless accept this deal to bring a close to this almost 2-year-old war, not just in order to stem or end Palestinian suffering in the Gaza Strip, but also to prevent further escalation on other fronts that might destabilize the region. For a stakeholder like Turkey, there's a potential to build on the budding relationship between the leader of Turkey, Erdogan, and the US President Trump. So yes, the major stakeholders probably have their own interests at heart, as well as humanitarian interests. The big question is whether Hamas will heed what appears to be fairly wall-to-wall agreement that it's time to end this war, more or less on the terms outlined in this proposal.
Sure. We'll wait for that to potentially come. Bloomberg's Dan Williams in Jerusalem. Dan, thanks as always for your reporting. Appreciate it. Now, rescue efforts continue in the central Philippines after an earthquake that killed at least 69 people and injured around 150 others. The 6.9 magnitude quake struck late on Tuesday, and officials say many victims were killed in their homes or hit by fallen debris. It's the country's deadliest quake since 2013. And still ahead, a U.S. accord granting duty-free access to the world's biggest market for products from 32 African nations has now officially expired. We have more on this a little bit later on Horizons Middle East and Africa. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Goldman Sachs is among financial firms planning to open offices in Kuwait in a boost to the OPEC members' efforts to position itself as a regional business hub. Sources tell Bloomberg the Wall Street giant could be joined by Carlyle, Franklin Templeton, and State Street, which are all also looking to set up local offices. The firms already count Kuwait as a client, and a physical presence would allow them to further strengthen ties with the government and its $1 trillion sovereign wealth fund. KKR has bought a minority stake in ADNOC Gas's pipeline network, adding to its $90 billion infrastructure portfolio. It's the firm's second deal in the Middle East this year after investing in Gulf Data Hub, one of the region's largest data center firms. Details on the financial terms or the size of the ADNOC stake have yet to be disclosed. And European private equity firm Investidustio is buying Saudi Arabian food producer Al Fursan Al Mahwer. The deal is subject to regulatory approval and is expected to close later this month. According to a statement, the acquisition marks the first ever majority transaction in Saudi Arabia backed by a European PE firm. And let's take a look at where your markets are positioned ahead of the trading day. U.S. equity futures largely flat, though tilting in the green right now. And as we mentioned, this is the official start of the second day of the U.S. government shutdown. But investors largely shrugging the shutdown off, especially if you look at U.S. equity futures. Also, Asian equities rallying. Euro Stock 50 futures up just about 0.5% there. Let's also take a look at potentially oil. We are awaiting some indication on OPEC Plus and potentially them returning more barrels to the market. We're seeing Brent crude, though, up just over 0.5%. That even as we got some indication about U.S. inventories increasing overnight. Coming up, Churchill Asset Management lays out their playbook for trading in the U.S. That's next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks gain following a global rally as traders look past the political impasse in Washington. The White House plans to dismiss federal workers, saying layoffs would happen imminently. President Trump says he'll press China to restart soybean purchases when he meets Xi Jinping later this month. And a U.S. trade accord which granted duty-free access for 1,800 products from 32 African nations has now officially expired. The details on that next. But now it has just gone past 8:30 a.m. across the Emirates, 6:30 here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. And again, investors looking past, for the most part, that U.S. government shutdown. Many people may be asking, shutdown, what shutdown? Especially if you look at U.S. equity futures. S&P futures largely flat, though tilting to the green, nudging higher as the U.S. shutdown officially is entered into its second day. And we are are seeing Asian equities as well as U.S. equity futures still edging higher, even as we do enter the first, or we're in the first shutdown that we've seen in the past 7 years. Let's take a look at U.S. Treasury yields right now. The U.S. 10-year yield marginally up right now. We did, though, see Treasuries rallying after we did get a surprise ADP private data print on Wednesday showing that payrolls last month did fall, that potentially helping to reinforce bets that we will see more Fed rate cuts later this year. The U.S. 10-year yield, though, at 4.1020 there. I also have the emerging market currency index on the board, largely flat right now, though I think some of the price action that we've seen over the past few days has been interesting, especially if you take a look at a little bit of dollar weakness that we had been getting. The emerging market currency index had seen three straight days of gains. And also on Wednesday, we did see the South African rand being one of those EM currencies being the beneficiary of a weaker dollar, hitting the strongest level in over a year against the greenback. Of course, the rand is also a nice gold beneficiary because, of course, South Africa does produce gold. And if we end on gold here, again, largely flat, even despite the shutdown continuing in the U.S., though this flatness coming after a 5-day rally for the metal. Right now, spot gold holding at $3,865 an ounce there. And really quickly, let's bring you this terminal chart of the day, which focuses in on oil and potentially indications of waning oil demand that's starting to build. We got some U.S. crude inventory data overnight showing that we are seeing crude inventories continuing to climb. That in the face of Trump's continued push for a resolution and a peace deal for Gaza. And, of course, the OPEC Plus meeting that is coming on Sunday. Potentially some analysts suggesting that oil is at risk of breaking a pivotal level. Brent crude right now is trading at just about $65.70 a barrel there, but plenty to watch for. And really quickly, let's just bring you some breaking news that we just got into our newsroom. And that is, of course, on OpenAI right now. We just got some word that OpenAI actually completing a share sale at a record $500 billion valuation. Of course, we have been talking to a number of our reporters, especially about the AI trade and how that continues to fuel equities globally right now. Our indication, though, is that OpenAI completed a deal allowing current and former employees to sell about $6.6 billion worth of shares in the company. That, according to a person familiar with the matter, valuing the company at about a $500 billion valuation. Plenty to watch out for there, but that is just some breaking news that we did just get into our newsroom. Let's, though, check in on how markets in Asia are faring. Min Lo is standing by and watching very closely how things are playing out there. Min, quite a bit of green on the screen. Take us through what you're watching.
Yes, Jen, that breaking news coming right in time. It's all about tech here in Asia. That OpenAI deal, signing a deal with both Samsung and SK Hynix, the Korean chip makers, which will be supplying chips to the company. A new data center being built in South Korea. Look at SK Hynix. It is at 10% higher now. Samsung as well. And it's really lifting all boats. Tokyo Electron, not related to the deal, but still also up about 7.5%. TSMC also in focus because Sam Altman is touring Asia and reportedly going to have a meeting with TSMC as well. So it's up 3.4%. But flip the board, take a look at how the tech sector is doing in China as well. Alibaba in focus because JP Morgan just raised the price target for this stock by 45%. Massive. We're talking about 240 as the price target there. It's up 4% or so now, and some of these cheap chip stocks as well. SMIC up a whopping 9%. So that's really lighting a fire under the broader regional benchmarks, right? You flip the board, take a look at the Kospi and the Hang Seng, both riding on this AI euphoria. And in fact, the Kospi is at an intraday record high right now. Now, what is going to threaten this AI euphoria is one thing, a potential fallout between President Xi and Trump. And that is why we'll be watching very closely that expected meeting between the two leaders when they meet at the sidelines of the APEC summit in South Korea.
Thanks so much, Min Min Lo in Hong Kong for us. Quite a bit of AI euphoria. And of course, failed to mention, but want to mention now, OpenAI now reportedly becoming the most valuable startup in the world after that news. So plenty to watch out for, especially when it comes to the AI trade. Let's get back, though, to our top story, which is the shutdown. Investors have largely looked past the political impasse in Washington. Let's bring in Randy Schwimmer, Vice Chairman and Chief Investment Strategist at Churchill Asset Management. Randy, thanks so much for joining us. So you have, and the firm has seen quite a bit of shutdowns in your time of operating. Does this one feel different, though, to previous shutdowns?
Well, thank you, Jennifer, for having us on. And yeah, having been doing this in private capital under the Churchill banner now for almost 20 years, and then even longer. If you think of our parent company, Nuveen, which has been around for 100 years and was one of the largest investors in private capital globally, we've seen at least 4, maybe 5 shutdowns. And one of the advantages of having been around long enough is you kind of see a couple things. One is that these do tend to be short term. Both parties realize ultimately that it's not good for anybody to have these the government services shut down for any length of time. I think the other thing that, from an investor's perspective, that we keep in mind, and I've been in the Middle East now visiting clients all week, and one of their concerns just generally is what is the unexpected that could come out of not just the U.S., but globally. And you think about the last 5 years, Jennifer, we've had so many of these unexpected events, whether it's COVID, whether it's tariffs, interest rate volatility, and so forth. And so one of the things that our very sophisticated clients in the Middle East are looking to do is to figure out ways where they can diversify their holdings into more alternative strategies, such as private capital, that provide some diversification and, frankly, lack of correlation with headline risk, because you never know what's going to happen.
Where then do you look, Randy? Do you stay within the U.S.? Do you look to other markets? How are you positioning right now? Especially, you know, a number of the headlines indicate potentially this won't be a long shutdown. How do you position? How do you protect your position as well?
Well, over the last 20 years, Jennifer, we've realized that U.S.-centric companies, particularly those businesses that are in service sectors such as healthcare, technology, software, logistics, specialty distribution, these businesses tend to be much more sheltered from global trade risks, tariffs, and even from high interest rates. If you have a company that has very high free cash flows and low labor content, you tend to be able to be more resilient through a number of cycles. And what we've discovered of over 20 years of investing billions of dollars on behalf of our clients, both institutional and wealth clients, is that staying local is really important in the U.S. There are probably about 300,000 companies that are between the revenues of, say, 10 million up to $1 billion. Only about 10,000 of those are owned by private equity firms, which means there's a huge amount of white space for growth. We think that these business services tend to be more resilient during, for example, slowdowns in the economy, high and low interest rates, and these exogenous factors that we've seen over the last 5 years, including global conflicts and tariffs and pandemics.
Randy, how much exposure do you and the firm have to U.S. Treasuries?
Well, one of the things that we've also learned, particularly just let's talk about the government in general, government agencies, government contractors, that having exposure to anything that would be impacted by a government shutdown is probably something that's not a good idea to have any exposure to. In terms of treasuries, you know, the liquid markets are really the province of other areas of Nuveen, which is one of the leaders in both fixed income and public equities. Now, our focus tends to be on the private businesses, non-traded companies, mostly backed by top-tier private equity firms who are also partners with us in investing in those businesses. And we found that our investors are seeking diversification away from fixed income, away from treasuries, which, as you know, from an interest rate perspective, tend to be the most volatile and the most sensitive to changes, particularly headline risks that we've seen on and off for quite a while now.
And Randy, just to wrap up, I wonder how much exposure do you have right now to the AI trade in particular? We were mentioning OpenAI earlier in the show. Of course, we've seen the AI trade fueling a number of tech companies. Where do you position right now to get the most benefits, especially with the current valuations?
Sure. We tend to focus less on the large mega AI businesses. Again, our focus is more middle market. But what we found talking to our private equity clients is that they are continuing to expand their use of AI, particularly in business services, where the need to improve data collection, data analysis, production, for example, with service businesses, payment solutions, anything where large amounts of data are required to be assembled, calculated, and processed quickly. AI has been an enormous tool. And in these smaller middle market companies, we're seeing continued and increased use of AI as a tool. And I think over the next 5 to 10 years, we're going to continue to see that as an area of growth, particularly in companies that are in these service sectors focused on doing more with less, and particularly, keeping costs down in times when revenues may be challenged, just given what's going on in the world. We don't think GDP, for example, in the U.S. is going to be particularly strong next year, and we think in that environment, private credit is going to do quite well.
Wow, plenty to look out for, though. Randy Schwimmer, really appreciate you joining us and sharing your insights. Vice Chairman and Chief Investment Strategist at Churchill Asset Management. Randy, thanks so much for your time. Now, coming up, EU leaders are meeting to discuss the region's defense strategy. We're live in Copenhagen next. This is Bloomberg. European leaders meeting in Copenhagen are discussing how to focus the continent's defenses and reinforce support for Ukraine. On the sidelines of the meeting, the CEO of Norwegian defense giant Kongsberg told our chief Europe correspondent, Oliver Crook, that a so-called drone wall could be a part of that plan.
The drone wall is a part of a bigger air shield defense. Kongsberg are into the air shield defense. We are having our air defense systems, which is a medium range today. We are expanding that ambition to expand that to the long range. I guess it's also quite recent what we have seen here in Denmark and in Copenhagen. Yeah. But it's for me it's a part of the entire air defense system. Mm-hmm.
Meanwhile, leaders are pressing ahead with a plan to provide $164 billion in loans from immobilized Russian central bank assets. Chief Europe correspondent Oliver Crook is joining us now from Copenhagen. Ollie, thanks so much for being with us. Talk about how exactly this would work.
Yeah, so this has been a big debate about what to do with these immobilized Russian assets that are sitting right now in Euroclear in Belgium, about 140 billion euros of it that have been untapped, and what should be done with it. We've had a huge amount of pressure from the United States for many years for the Europeans to begin tapping these and monetizing these, even under the Biden administration. Now with Trump coming in basically saying he will not give any more support to Ukraine in the form of U.S. taxpayer dollars, the Europeans have had to look seriously at doing this. And now, critically, the person who's behind it is the German Chancellor Friedrich Merz, who had previously been very against this. There was a lot of questions about the legality of this because the Europeans don't want to be seen to be basically reappropriating the assets. So what they will likely do is put forward a loan that will be backed by a number of member states, about 140 billion euros to go directly to Ukraine. And the idea here is to basically prove to Vladimir Putin that there is enough funding for the Ukrainian military, not for this year, not for just next year, but for about basically 2.5 years, and that this is going to be a long, drawn-out process if Russia wants to just wait everybody out. Now, what seems to be happening here is there's going to be another leaders meeting in a couple of weeks' time where this potentially will have an actual step forward. There are a couple of flies in the ointment. First is Belgium, which is holding these assets and doesn't want to basically have to contravene or do anything sort of illegal. So they need some assurances from European leaders. And then there's, of course, Hungary, which has been the sort of obstructor-in-chief for all sort of collective European efforts, though it seems as if there's going to be a way to, A, win over the Belgians and get this plan moving forward in order to basically unlock that huge amount of money, which will go a very long distance in funding Ukraine's defensive war against Russia.
Yeah, a lot of these discussions, fascinating to see how they evolve. Oliver Crook there, our Chief Europe correspondent, still on the ground in Copenhagen. Oliver, thanks so much. Now, coming up, a decades-old trade pact between the United States and dozens of African nations has expired. We'll look at the ripple effects for economies and consumers next. This is Bloomberg. A U.S. trade accord which granted duty-free access for 1,800 products from 32 African nations has expired. The Trump administration, though, has signaled support for a one-year extension, but legal uncertainty is leaving investors and exporters in limbo. For more, let's bring in Bloomberg's Ndiro Oganga, who's joining us now from Kigali. Ndiro, what's the real impact on the expiration of AGOA for African exporters, consumers, and also jobs?
Good morning, Jennifer. So the impact is really clear. The African Union estimates that 350,000 direct jobs are going to be impacted. 1 million indirect jobs are also at risk. And if we just put this into context of countries, take Lesotho, for example, 12,000 jobs at risk, and this is a third of the total industry. Kenya, 66,000 jobs at risk. And these are just not numbers that are pulled out of thin air. If we go back to 2021, when Ethiopia lost their AGOA access, 11,000 jobs were lost. And so what we're looking at right now is U.S. consumers could be contending with higher prices and also a reduced pool of goods to choose from. And also the one-year extension that you're mentioning, though it's welcome news, it does very little to ease the tension and anxiety that businesses are currently experiencing, and it will make it really difficult to do forward planning. When this AGOA agreement fully expires, what we're likely to see is a major drop in imports, particularly from countries like Kenya, Tanzania, and South Africa. And these losses are expected to be heavily concentrated in motor vehicles, metals, and also things like chemicals. You add to the fact that Trump introduced tariffs 10 to 30%. But there's a caveat to this. Certain energy goods and metals are exempted. And this begs the question on the new trade trajectory that President Donald Trump wants to take with Africa. You have African leaders saying they want to veer away from exporting raw materials, but then they have tried to build manufacturing economies. They're adding value to their goods and creating jobs. And now Trump is saying, away with that, we just want raw materials. So on top of the $8 to $10 billion that is at jeopardy, systems and ecosystems could also be at risk.
Yeah, it's top of mind for a number of leaders. Bloomberg's Ndiro Oganga in Kigali, Rwanda. Ndiro, thanks so much for being with us. Now, FirstRand CEO Mary Vilakazi echoed a similar sentiment that Ndiro was just walking us through there. In an interview at Bloomberg's Women, Money and Power conference, she said businesses in South Africa aren't betting on an AGOA extension and are making plans to minimize the fallout.
Our clients that operate in sectors where they export and they've been beneficiaries of AGOA are already making plans, but I mean, there's no doubt that it's going to have an impact on jobs. It's going to have an impact on just those companies' ability to grow, and more so the countries on the continent. You know, I think South African countries now reading the leaves for the last couple of months, they are not betting on AGOA being renewed. It would be great if it's actually renewed, but I think that they are making alternative plans. But I mean, across the continent, some markets are, they don't have the kind of resources to be able to diversify away. So again, hopefully that's one that it goes through Congress and it's again supported. But yeah, I mean, I think there's also quite a high likelihood that that's not the one where South Africa is able to be successful. I mean, if you look at Botswana and Lesotho, some of our neighboring regions, their tariffs are lower and South Africa is higher. So we cannot discount the fact that, there's a political tension there that might get in the way.
Yeah. That being said, we're talking about all of these global macro headwinds. If you look at when you posted your earnings a couple of weeks ago, my colleague Jennifer Zabazaja spoke to you around the earnings. Pretty solid earnings growth, north of 13%. Where is that growth coming from in an environment where there's so many global macro uncertainties?
Yeah, so I guess the mean, GDP growth in South Africa has really been lackluster for quite a number of years, and largely because the economy has been hamstrung by state-owned entities that have a monopoly on transport, energy, that have not been functioning for a very long time. So one of the things that give us hope, and I think we're able to be constructive with the outlook, is the economic reforms that are taking place in the country. So on energy, I think Eskom has done well to stabilize the days of load shedding, and then the energy factor and reliability factor keeps on improving, so that's a positive outlook. There are more reforms that still need to take place, but as business, we are encouraged that government at last is tackling some of these structural impediments to growth. So in the medium term, we're quite constructive about that. And again, on the transport and logistics side, that's also improving. There's momentum. Recently, about 11 private sector companies have been awarded a contract to be able to operate on some of the Transnet lines. So that's a big shift in South Africa.
FirstRand CEO Mary Vilakazi speaking with Bloomberg's Jumana Bersachi at our annual Women, Money and Power Conference. And for more stories like this from the continent, of course, be sure to subscribe to the Next Africa newsletter on the terminal and our website. You can now also get the latest news from the continent on our weekly podcast, available on Apple, Spotify, and wherever you get your podcasts. And of course, for a deeper dive, catch our TV show Next Africa, airing on TV on the last Friday of every month. You can still watch our previous episodes in full on your terminal, on the website, and of course on YouTube. Now let's again take a quick check at where your markets are positioned ahead of the trading day. Of course, all eyes are on the U.S. government shutdown, but if you take a look at U.S. equities, we're still seeing some strength despite the first shutdown in 7 years. S&P futures and also NASDAQ futures tilting higher in the green right now. And of course, on Wednesday, we did see U.S. equities hitting another record. So plenty to watch for later as the day progresses. But that is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg.